Okay, in this tutorial, I'll be showing you how to find, it will be another stock. So I'll just go through with you right now. If you just have a look at the symbol CLCT, I'll just copy that and I will just paste that in Google and I'll write stock. Okay, so I can see Collector's Universe. That's the name of the stock. So on this side, on the right side, it's information from Wikipedia. On left side, it's information from Google. So let's go through together. So if you see the last sale or the recent price is 20.98, which is the price of the stock. So if you buy the stock right now, you have to pay 20.98 US dollars per stock. Um, so I'll just change it because mine is different when I did that. When was it founded? You can just see from Wikipedia, it's 1986 founded. Okay, so I'll just type in that. And then the sector is industrials. I'll show you from where you can see that. Um, then now what I look at is I have some ratios that we can just check, just scan the stock if it's good or not. Um, I normally use, depends what you use. I normally use Macro Trend. That's a good website. I go to price ratios, I go to price book ratio. I can type in or select the stock by symbol or name, and I'll just see that the price book ratio is 10.83. So this means that the stock price is 10 times more than the book value, 10.83 times more than the book value. So it means this stock is very expensive. It's 10 times more expensive than what it should be. So if somebody buys it now, they'll be paying 10 times more price for the same share. But in 2018 December, it was 6.73 times more than the book value, so it was cheaper. So somebody who bought that time in December, they could buy more stock, same stock, with less price, but still it's 6 times more than the price it should be. It's still expensive. And if I look at December 2017, it's 17 times more expensive than it should be. So people who bought in December 2017 paid a lot of price for the same stock, and people who buy now will be paying less price for the same stock. And but if I come down in 2012 December, the price of the stock is 2.67 times more than the real book value, which is better. So people who bought that time paid 2.67 times more price for the same stock, but people who will be buying now will be paying 10 times more price. So people who bought that time were could buy the same stock more with less price. But if I come in 2009, it's 1.19, so which is very good because in 2009, the stock and the book value is nearly the same price, but still it's 1.1. People who bought that time has paid 1.19 times more price than its real price. But if you look here, this in 2008, it's ideal because the stock is undervalued. So the price that people paid at that time is lower than the book value. So it means that if somebody buys stock at that price at that time in 2008 December, they are buying it very cheap and it's undervalued. So they are paying 1.44 price, but in return they are buying $3.24 worth of stock. So they are it's a lot of bargain that time. But um, now it's 10 times more they're paying the price, which is not very good. So it means they're buying expensive stock. If I go to debt to equity ratio in other ratios, and then I click debt to equity ratio, I can just have a look that this one is 0.11. So if debt to equity ratio is 0.5 or lower than that, that's really good because it means that the company is relying more on the equity. It's operating more on shareholders' equity than the long-term debt. So which makes it more safer. So it is better to invest. So if it's lower than 0.5, that's really good, or 0.5. So if I just go back, it's 0.14, 0.15. So the trend has been lower than zero point 0.5, so which makes this company very risk free, so which is very good. And so it's a good sign. If I go to return on equity, which means that what the shareholders are getting by investing, so it's 52%. So if it's 8% or more than that, then that's really good. Otherwise, it's not really good. So if I just go back, and it's consistently more than 8%, it's consistently more than 8%. But here in 2009, it's not, it's very it's like in minus, so that's not good. So it's not giving any return for the equity the people have invested in 2009. It's not giving anything. 2008, it's minus. It's not returning anything to shareholders. 2008, nothing. And then, so this period from 2008 to 2009 December, it has not given anything to their investors, which was not good. But since then, in 2010 to March 2010, it has been giving a lot of return to their shareholders, which is, it means um, it is attractive from 2010, and it has been attractive since then. And it's been 9 years now, and it has consistently giving return on equity more than 8%, which makes it very safe to invest in. If I look at current ratio, I can just go to this one, and I can just have a look at that. And if the current ratio is more than 1.5, it's a lot more risk free, so you can invest in it because it tells that it's a lot, that it has a lot more assets than its liabilities, which is very good thing. So I'll just go back and see if it has been consistently like that. 1.62, 1.48. Now, in 2018 June, it has been lower than 1.5, but it has been like 0.02 lower. So still, it's more than 1. That's still very good. But if I go back, it has been more than 1 altogether, 1.5 and then 2. So the consistency has been really good. Just for 1 2 areas, you can see it's lower than 1.5, but still it's been above 1. So still it is very attractive. So it means throughout the current assets has been more than its liabilities, which is a very good thing. If I want to check dividend, it's very important to check dividend, not to ignore that, because it tells that the firm is doing very good and it has extra cash to pay its shareholders. It gives a very good image, even though the dividend yield might be very low percentage, but still it's an extra money that it's making, that it's paying to shareholders. So which is a very good sign of firm. And I can see dividend yield of 3.34%, which is really good for that. And if I want to see if it's a billion or a million company, just to know the market cap, how big the company is, I can see it's a million company, so it's like a medium size. Maybe it's a million company, 191.93 million. That's the market cap. I can also see its patents. I can see the patents. So I'll just copy that. I'll go to patents, Justia, and I'll just click on the search bar and enter, and make sure that it's the same thing you're typing. Now let's have a look. So that's what you're looking at. Assignee, not the inventor, but the assignee is the person who has all the rights of the patent, so which should match your collector's universe. Same thing, yeah. In 2005 they have a patent, then in 2007 they have a patent, filed a patent, and I that's not the one. Okay, so they have just two patents, but they don't have any, but that's really good, but they don't have any recent patents. The last patent was in 2007. So that's not you know, I need to be careful about that, because since like it's been like nearly 12 years now that it doesn't have a new patent, so that might be something that we have to look at, because it means it might not be innovating anymore, or for you to thrive or to be successful in long term, you need to have patents, because the patents are like they separate you from your competitors. it gives you a competitive edge, it gives you a moat, and it acts like a moat, and it gives you margin of safety. So it has patents, two patents, which is good thing, but since 12 years it has no patents. So that's something to be looked at. And lastly, I'll go to Yahoo Finance. I'll click on the first thing and I'll just type it in search bar, and I'll click and I'll just let me have a look. What's the CLCT? Sometimes it doesn't come with a name, so I'll just type its thing, the symbol, and that's the Collectors Universe Inc. Sometimes it doesn't appear, I don't know why. I go to profile and I'll just show you one thing. The sector I was talking about, it's industrials. So you can just see the sector from here, from Yahoo Finance. Industries, business services, and then if you want to have a look at key executives, just I'm just interested here. You can see there are two people that are listed and both have pays listed, so which is very important. It makes the firm very, it makes the thing very transparent. It's very important to have a look at the pay, that it makes the firm look attractive because they haven't hidden anything, hopefully. And it has 343 full-time employees, but that's very important to look when you're looking at the pay. You can look at other things as well. You can search each of them in LinkedIn, or you can see their previous things. You can look at the website and everything. So that's very important as well. And